Let's talk about what the heck is going on with this crazy Canadian real estate marketplace. There was an article in the Financial Post that talks about, some markets being hot, red hot, I think was the term that they used, and some being cold. You've got the Toronto, Ottawa, Calgary, they're all way up and doing really, really well. And then in Edmonton, Regina, and Saskatoon, there's a whole bunch of construction projects that are finishing, that are bringing new inventory into the market, which is pushing prices down a little bit. But what does this mean? And in particular, because of today's Emily episode, what does this mean for the first-time home buyer? So prices are high, so generally that just means your down payment's going to have to be higher, or you're going to have to make sure you have enough down payment. But the offset to having more down payment and paying a higher price for your house, of course, is that interest rates continue to be incredibly low. I mean, in my mind, because I've been doing this for so long, this is pretty much free money, and it's been free money for like 10 years, pretty much. But part of the risk of being a first-time home buyer today is that if you purchase a property and the value doesn't hold in the next 10 years, so say, over the lifetime of the real estate market, prices generally go up. But the point in time we might be at right now is where you're buying at the very, very top of the market, and we might see that the market comes off for the next decade, and then it starts to come up again. The interest rates, of course, could have a downward pressure on house prices, and in particular, where the supply of homes is plentiful, where there's lots of inventory. If interest rates start to go up, then those prices are going to have to come down in order to have those houses move in the market. But it doesn't appear that kind of in the major centers in Canada that's going to happen anytime soon. Yeah. Make sure you have a long-term view if you're a first-time homebuyer, because that whole idea that maybe you are purchasing at the very top of the market, maybe your house price doesn't rise, but maybe it doesn't fall. You might find that after you've made 5 years or 10 years worth of mortgage payments, that really you just paid a ton of interest and your house didn't kind of rise above the cost of what that mortgage was. And so that's part of your risk. But you can hedge some of this stuff. You can have a plan. And part of that plan would include two big things: either paying down your mortgage to the best of your ability every year. I mean, if it's a $500 or $1,000 or $10,000, take advantage of those prepayment privileges to chop that principal balance down quickly. And if you can't do the lump sum principal payment, then make sure that you're doubling up your payments. You can at any time, most banks will let you call them and say, look, I'd like to increase my payment by 20% or 25%. And that increase goes directly to principal, which of course helps you pay off the balance quicker. Like everything in this crazy Canadian real estate market, do your homework. Understand the prices of homes. Understand where they need to be for you to at least keep your investment at par. And while no one can predict the future, certainly there's enough information out there to help you understand, well, where does my house have to be in the next 10 years if I'm going to not only recover the interest that I've paid, but also realize a little bit on my investment. And so do your homework, understand your costs. And another big one for those of you that are employed is to understand how confident are you about your employment prospects over the next 10 years. If you think you're going to continue to be employable and earn the same level of income that you earn today, then that's something to take into consideration when you buy your home. If you're not so convinced that your job prospects are going to be really, really great, then maybe today's not the best time to buy your home if you think that real estate prices might come down, because if you lose your job and then you have to sell your house, but you can't sell it for the amount of the mortgage, then it's going to be a very long time till you buy a house again. And so that's something to keep in mind. Another thing to consider is, can you find a way to budget your expenses so that you can make principal payments against your balance? Most first-time home buyers at the beginning of their career or their life with their partner, everyone kind of has their separate bank accounts and everyone just sort of spends their money. But budgeting can be really, really tough. In fact, it can take years to get a good budget put together. But if you bought your home, that's usually a pretty good time to look at your expenses and say, hey, how can we save $500 a month, or how can we save $200 a month and take that money and apply it against our mortgage at the end of the year? So that's something to consider. Take some time to know your options. At emilynow.ca, we've built a platform where you can do exactly that. It's a pretty innovative and disruptive idea. It's meant to show you what the based on your information, some simple information from you, kind of how you score out of 10, and based on that score out of 10 you can see what interest rates you would qualify for, you can see the banks or lenders that would be eligible for your request, and then you can send your request to our client services team who'd be happy to help you. You can send your request directly to the bank and we'll help you facilitate that so that you can just do more and not waste your time with applications and meetings and trying to find time in your schedule to go sit with a mortgage specialist. You can do it all from the convenience of your computer, and so we'd encourage you to do that.